Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I just want to say a big welcome to everyone for the new year. I hope everyone has had a safe and prosperous holidays. I welcome everyone back, and I hope you guys are having a great time. And someone just noticed that I have 2019 on my slides. Thank you so much, Jake. I will make that correction before we send this out. So today we're here to talk about how to hedge your portfolio against a market correction. And this topic is, I think, fairly timely for the current market conditions. We have S&P 500 near all-time highs or at all-time highs, and quite a bit overextended and overbought right now. Actually, about almost 9% above its 200-day moving average, which is a fairly extreme reading. And many times when we get up to those types of extreme readings, we typically see some form of consolidation or pullback. Now, there are many ways to play this. Certainly, at the very least, if you feel that the markets are going to consolidate, selling cover calls is a good way to collect some premium and offset the cost that you might want to utilize to buy some puts if you do expect a bigger pullback. Now, we broke out above 302 on the S&P on SPY in October, and we've just moved straight higher since then. So really what we're trying to see is are the markets are going to pull back down to around that 302 area. So this is really where we can utilize options to potentially stay invested so that if there's further upside that we are still going to capture those gains. But in the event that you have a correction, how do we protect our portfolio, especially at these current levels when volatility is cheap? You can go about buying some puts on your portfolio. So we want to talk about that strategy. We want to talk about best practices on how to go about doing that. So before I get started, just a little bit of housekeeping. For those of you that are brand new to OptionsPlay, you can sign up for a free 30-day trial to the tools that I'll show you here today. I just posted a link into the chat window for those of you that are new and getting started with options trading. Membership is just $75 a month or $500 a year after your free 30-day trial. And included in that is a free 12-step options trading course and daily options trading ideas. And to ring in the new year, I do have one big announcement to make. We are now on Options Action every single Friday evening on CNBC. I'm now a contributor to that show, and you can catch me on that show tomorrow afternoon at 5:30 p.m. So I hope to see some of you there. You guys can live tweet us during the shows to ask us any questions regarding some of the trades that I'll be putting out. Every single week, we usually send you an options action trade that is usually structured by Michael Coe and Carter Worth. Going forward, we are also going to use those, but as well as the ideas that OptionsPlay puts out on that show. So I hope to see some of you on that show. So let's go ahead and get started here. Current market outlooks and expectations. I want to give everyone an outlook of where we currently stand, what our expectations are with the current outlook, and that will frame why we might want to take a look at a portfolio hedge. A lot of people asked us to cover this topic at the end of last year, but we didn't quite see the sell-off that we were expecting to, and we're actually even further overextended now. So I actually think now is probably a better time to think about this type of strategy. We'll talk a little bit about what a portfolio hedge is for those of you that are brand new to options trading or brand new to this strategy, making sure everyone understands when you should utilize this and who should utilize a portfolio hedge, because it's not for everyone. Portfolio hedging many times can be very expensive. It requires you to be very tactical in terms of timing. So it's really important to understand when you should utilize this type of strategy and when you should not. And then once you understand the strategy, then we'll talk a little bit about the optimal portfolio hedges, talking about expiration dates, strike prices, what makes sense, and then lastly, going through some real examples to show you how a portfolio hedge will perform during a correction in the market. So like I said, markets are about 8% above its 200-day moving average, broke out above 302. I think you can get a pullback somewhere in that range of 3 to 5%, upwards of 7%. And if you do see those types of corrections potentially happening in the next couple of months, this is the type of trade that you might want to put on to protect your portfolio against those types of corrections. So as you can see, this is a current snapshot of the weekly and daily chart of the S&P 500. And like I said, here in late October, what we saw was a breakout above this major 302 level. We broke out above it, and it basically has not turned back. We had that small correction here that lasted for just a couple of days before it continued moving higher. And the question is, the fact that notice how far away the market is away from that 200-day moving average. That is currently at a fairly extreme reading. And notice the last few times we've had these types of extreme readings, the market has pulled back fairly significantly, sometimes fairly aggressively. So the question is, are we going to get another check back to this 300 level? And just for those of you that are on this webinar right now, if you can just a quick poll, how many people are concerned about a pullback in the next couple of months back to that 300, 302 level on SPY? Answer a yes or a no in the chat window at the bottom of your screen. Yes, if you are concerned about a correction, and no, if you are not. Okay, so we see a lot of yeses, but I also see a fair number of nos, which is interesting. For those of you that do not expect a pullback, generally speaking, it's not uncommon to not have a pullback either. However, with these types of extreme readings, we typically, at the very least, get some form of consolidation. So meaning I don't expect markets to continue to shoot higher because I do feel that the markets are pricing in a lot of good news. You know, we do have earnings seasons coming up, which will typically bring volatility a little higher. But if the last few earnings seasons is any is a template for what we're going to see this quarter, likely what we're going to see are stocks that beat will have somewhat muted gains, but stocks that miss will have relatively large pullbacks. And I do see a lot of users here saying that they are not really concerned of a pullback. Let's see some of the comments here. Looks like a lot of people saying that you're not concerned about a pullback of magnitude, that you might see a small pullback. And keep in mind that even a small pullback of 3 to 5% can still be offset with the put option. So let's take a look at some of those things. Number one, like I said, overbought and overextended conditions. This does not mean we're going to get a pullback. It just means that the probability of a pullback is relatively high. If we look at the calendar in terms of catalysts, certainly earnings season coming up is one potential catalyst, but we do have the potential signing of the phase 1 trade deal on January 15th, which has not been confirmed by China just yet. So there are some risks there. We do have a fairly dovish Fed policy. We have minutes coming out tomorrow afternoon, which is something that we should keep an eye out on because of the recent thoughts on the Fed in terms of how they're going to think about inflation in the next decade. And lastly, I think one thing that we also have to keep an eye out on is the fact that this recent rally has predominantly been fueled by two things: Fed providing liquidity in the markets and consumers spending a lot of money because unemployment is relatively low, wage growth is fairly strong, consumers are fairly confident in the economy and they're spending quite a bit of money. If we look at Christmas spending, it was extremely strong this Christmas, and we kind of expect those types of numbers to continue to roll into 2020. So things are very supportive of a bullish market here going into 2020. As far as how far we can go in 2020, I doubt we're going to have another 30% year like we did last year. However, we are fairly supportive of markets continuing to move higher. But my concern is that we do have some pullbacks during this year, because this particular year, 2019, has been pretty much straight shot up with very small corrections in the meantime. I expect 2020 to have some larger corrections, and this is exactly why we are doing this particular webinar at the beginning of 2020 to prepare you for when you do see some type of pullbacks, how do you protect your portfolio? So in order to understand hedging your portfolio, we must first understand what are our options, because there are multiple options that you can utilize that do not involve trading options. So if you are expecting a pullback in the markets, whether it's because of earnings or different types of catalysts, there are different things that you can do to position your portfolio. Number one, there's a thing called a perfect hedge. A perfect hedge is simply moving your assets into cash and hoping and reinvesting after the correction is over. So this is the most efficient way to actually hedge your portfolio. So if you have a stock portfolio, you believe that the markets are about to correct, move those positions into cash. After the correction, move back into those positions. That is the cheapest and most efficient way to hedge your portfolio. The second way you can hedge your portfolio is to reallocate into more defensive assets. So you can think about traditionally moving into fixed income is a very common move into more defensive assets when things are going when things are going sideways in the equity markets, moving to bonds, moving to even treasury-like investments like utilities, even energy companies now. The dividend yield on energy companies are actually higher than the dividend yield on utilities now because of the decline in energy stock prices. So we have about a 3.5% dividend yield on XLE, something we haven't seen in a while. So we tend to have flow into these types of higher yielding or securities that act like fixed income products that when things go sideways, we tend to move into those types of assets. High dividend paying stocks, there are plenty of them currently out there. And lastly, gold and commodities, certainly other forms of safe havens that people will fly to when things are going south. And lastly, there is what we call a portfolio hedge. This is where you are buying a put option to protect your portfolio. Now, before I talk about what a portfolio hedge, you must understand that portfolio hedges is really something you should only utilize if moving to cash is not an option, meaning you do not want to move your assets into cash for various reasons, because maybe you're going to have to pay taxes on or capital gains on those assets when you move to cash, and you don't want to do that, or maybe you rely on the dividend income or the dividend for income, so you don't want to move into cash and lose that dividend. There are reasons that you may not want to move into cash, and that might prevent you from utilizing a perfect hedge. You may not also believe in defensive assets, so fixed income. We no longer see a strong correlation of treasuries as your flight to safety. So perhaps you don't believe in other asset classes to protect you during a correction. And sometimes, many times in a short-term correction, moving into fixed income and moving back into equities is not really an efficient trade. So there's various reasons why putting on a perfect hedge or putting on moving your cash or moving your assets into defensive assets may not be a suitable play. Generally speaking, moving into defensive assets tends to be more of a strategy if you really believe that we're about to head into a recession longer term, where you might be holding on to those defensive assets for 3 to 6 months or maybe even a year. Then you might want to consider defensive assets. But if you're expecting a short-term correction, that's really where the portfolio hedge of buying a put option to protect your portfolio may be suitable. So that is a scenario that I think many of you are concerned about with the current market environment. Is a short-term pullback somewhere in the 3 to 7% range, relatively normal. That is where buying a put option might make sense. So a portfolio hedge is for anyone with a portfolio of stocks or ETFs. Whether you have a basket of stocks, ETFs, or you have some kind of equity exposure in the markets, this is the type of strategy for you. Generally speaking, it's to protect yourself against a correction greater than 5%, meaning if you expect the markets to correct 2-3%, probably not necessary to put on a portfolio hedge, just because it would be quite difficult to time a 2 to 3% correction. A 5 to 7% correction is more in line with when you might want to utilize a portfolio hedge. And lastly, you should only utilize this if you do not wish to sell any of your holdings. If you can sell your holdings into cash, remember that's always the cheaper, more efficient alternative to buying a put option. So it's really important that moving into cash is not an option. Moving into defensive assets is not something you're ready to do, because that's generally more so for a larger correction in the markets. Greater than 20% is when you want to consider moving into defensive assets. But if you're trying to protect yourself against a smaller term correction, a portfolio hedge may be the option for you. So in order to understand a portfolio hedge, I think the best way to understand this is to think of it like an insurance policy. Think about it as an insurance policy for your portfolio during a market correction. And this insurance policy is relatively straightforward to understand. What you're doing is you're buying a put option on a broad-based index. This could be an ETF or an index option. And how this strategy works is very simple. You will profit from the put options as the markets correct, which will offset the actual losses that you have in your portfolio. So a portfolio hedge does not actually stop the losses in your portfolio. It only helps offset it with gains from the put option. And this creates what we call an imperfect hedge, because what you're getting is not dollar for dollar hedging. So if you have a $1 million portfolio and the markets drop 10% and you lose $100,000 in your portfolio, the put option does not necessarily pay you $100,000. It might only pay you $50,000 or $70,000. It depends on the insurance policy that you purchase. So it's not dollar for dollar exposure. So you're going to get some form of protection, but it's usually not going to cover you 100%. The second thing to remember is that buying protection is very expensive. So many times when you think about an insurance policy, like your car or your home, you just always buy insurance and you're always covered. However, if you tried to do that for your portfolio, you would pay a lot of money to do that. I would not recommend it, because you will never be able to beat the markets or even come close to beating the markets if you are constantly buying protection. Buying protection is going to cost you a lot. Many times, somewhere between 1 to 3, many times 3 to 5% of the entire portfolio just to buy a few months of protection. So imagine if you had to pay 3% of your house value to insure it for a couple of months. You would lose all the money that you have in your home very, very quickly. So it's something that you only want to do when you expect the markets to correct. And this strategy really requires active management and timing, because you have to buy insurance when you think the markets are going to correct, and you want to make sure that you pull that insurance or take that insurance off once you believe that the correction is over. So it requires active time management and timing. So it's something that requires it requires to be a bit tactical in the markets. And many times, many traders will like to use technical analysis to help them time those corrections. So it's important to pay attention to where the markets are trading, pay attention to the news and understand what's moving the markets. And if the negative catalyst is no longer causing the markets to move lower, you must know when to take off that hedge immediately. So it's just as important to know when to put it on. It's also just as important to know when to take off that hedge. So those are the things that you must keep in mind when you're putting on a portfolio hedge. Now, I just want to make sure everyone understands the headwinds that you have when putting on a portfolio hedge, because it's not necessarily cheap or easy. So before I move on, just please, if everyone could just type 1 into the chat window if you understand when you should utilize a portfolio hedge and the headwinds that you have when you're putting on a portfolio hedge. Okay, perfect. I see a lot of ones. Great. So just a quick illustrative to help everyone understand exactly what I'm saying. What is a portfolio hedge? A portfolio hedge looks at your current portfolio, because this is what a current unhedged portfolio looks like. As the markets move higher, you make more and more money. As the markets move lower, you lose more and more money. And it's dollar for dollar exposure, meaning it's a symmetrical exposure. The markets go up by 1%, you make 1% in your portfolio. If it goes down by 1%, you lose 1% in your portfolio. And it's pretty straightforward and really easy to understand. So a portfolio hedge is also relatively easy to understand. What you're doing is you're buying a put option on an index or ETF, and a put option has cap losses because no matter what happens, the most you can lose on a put option is what you pay for it. But a put option pays for unlimited upside if the markets move lower. So the lower it moves, the more profits you make from that put option. Now, when you combine this put option with your portfolio, what you get is a chart that looks very similar to a call option, meaning you have limited losses to the downside. So if the markets keep moving lower and lower, what you get is an offset. So as the markets continue to move lower and lower, your stock portfolio will continue to lose money. Your put option will make money, and the net of the two is this capped losses line here at the bottom. And the difference here is that buying a put option, because the most you can lose on a put option is what you pay, what you still have is unlimited gains to the upside. So you don't lose the upside potential. The only thing is your upside potential is reduced by the cost of the put option, because now you have to pay for that put option and that has to be factored. But that's a limited amount. So if the markets continue to move higher, so if we get another 30% year after you put on a hedge, you might still make 28% on the year because you paid 2% for that put option. So that is the visual diagram of what a portfolio or of what a hedge portfolio looks like. Now, I just want to make sure everyone understands that before we move on. So please type 2 into the chat window if you understand this concept. Perfect, plenty of 2s. So now let's talk about the strategy itself. How do you actually go about putting this on, right? What expiration dates and strike prices? Number one, we want to talk a little bit about the instrument itself, because what you choose in terms of instrument is going to determine the efficiency of your hedge. So first of all, in order to create an efficient hedging strategy, we talked about timing. Number one, timing is extremely important in this particular strategy, meaning you actually want to enter a hedge during a correction. Now, many times you'll hear from users you might hear from someone saying, volatility is at all-time lows. If you buy insurance, it is very, very cheap to buy insurance. The problem with that is insurance is cheap all the way up, meaning if you could have bought insurance anytime in the last couple of months, it would have been at all-time lows. It would have been really, really cheap. But until the correction actually happens, you actually don't need insurance. And you're actually, yes, it's very cheap, but you're buying protection for something that you don't actually need. So in my opinion, you should only buy insurance during a correction. And yes, it will be more expensive during a correction, but you're only buying coverage when you need it. The last thing you need to do is buy coverage when you don't need it. That's how you're going to underperform the overall markets, because you could have bought insurance all the way throughout the entire year of 2019 because it would have been really, really cheap to buy insurance the entire year. But if you did that, you would have paid maybe 1% every single month for the last 12 months and paid 12% for the whole year to buy protection when you didn't need it. So cheap does not mean good protection. I would rather pay 3% when I need it and only pay 3% for the whole year than pay 12% through the whole year when I didn't need it. I hope everyone understands that. Second of all, you want to make sure you exit a correction very, very quickly. Now, the question is, when do you know the markets are near a bottom? And this is really where you can use, there are many contrarian indicators that you can utilize, and many of them are based on different types of option-based metrics. You can use put-call ratios, you can use VIX. You'll notice that VIX will typically peak during a market bottom. So there are many indicators that you can use. You can use put-call ratio, you can use skew, you can use VIX. These are all decent indicators of telling you when you might be near a market bottom. And that is usually something you can utilize the time exiting in a put option on a hedge. So timing is really important. Also, hedging instrument is extremely important, meaning you should pick an instrument that's closely correlated to your portfolio. So this is where you do have to do a little bit of work to understand what does your portfolio consist of. And the best person to understand that is yourself, because you should know what you're invested in. If you don't know what you're invested in, then I highly recommend you to take some of the tools that your brokerage firm may have to help you analyze your portfolio. Most brokerage firms have a portfolio X-ray tool or some type of tool that looks at your portfolio and lets you know how well diversified you are, where your concentration is, whether you have concentration in specific sectors, whether you have lots of large cap or lots of small cap, whether you have international exposure, domestic exposure. Understanding the makeup of your portfolio is extremely important in picking your hedging instrument. So if you have a well-diversified portfolio, something like a broad-based index like the S&P 500, either using SPY or SPX, any of these broad-based indices can be utilized to help you hedge your portfolio. And the whole goal is to pick an ETF or index that mimics your portfolio as closely as possible, because what you're doing is you're buying insurance on that product. And if that instrument moves in step with your portfolio, then you'll have an efficient hedge. But if you pick something that's not very closely correlated to your portfolio, then maybe your portfolio is down 10% and the hedge only returns 3-4% back. That's not what you want. You want to make sure that you pick something that moves along with your portfolio. Now, many of you have what I would consider very tech-focused portfolios, because if you look at the makeup of gains over the last few years, it's heavily been tech companies. So we see a lot of portfolios that have very large concentrations in tech. So this is where you can use an index like the NASDAQ 100 index, which has predominantly tech names in it and doesn't have any financial names in it. Or for those of you that maybe work in a specific sector, I know a lot of you work in perhaps healthcare or oil and gas or technology, where most of your stock is in a single name, right? So a lot of people that have worked in IBM for 30 years, they have a lot of IBM stock and their concentration is in tech, or vice versa. Someone who's worked in oil and gas and has a lot of Exxon stock or BP stock. You want to make sure that you pick something that's closely correlated to your portfolio. So if you have a heavy concentration in a specific sector, you might pick a sector ETF. And there are thousands of ETFs out there. So make sure that you understand the makeup of your portfolio and pick something that's closely correlated to your portfolio. I just want to make sure everyone understands that. Please type 3 into the chat window if that makes sense before I move on. And I know there were a few questions, and I promise I will get to your questions at the very end, and hopefully I will answer some of those questions as I go along. So now that we've talked about timing, we've talked about the hedging instrument, let's talk a little bit about expiration dates. So remember here, we're buying a put option. So whenever we're buying a put option, we want to make sure that the value of that put option holds as best as possible, because if the value of that option erodes, then that means that our hedging strategy is not very efficient. So what I have here on my screen is a curve of the time value of the premium and the time value of an option and how it erodes as you approach expiration. So as you can see, when you buy a longer dated option, it erodes at a slower pace than when you buy a weekly option or an option that's about to expire. The weekly options will expire at a faster pace than the longer dated options. So whenever we're buying protection, because we're trying to prevent the erosion of that put option, you generally want to buy longer dated options. So whenever you're buying a put option, you generally want to select at least 2 months out in time of time of your put option. And the goal here is to try to minimize your time decay. And we're trying to minimize our time decay over the time that we're holding that option. So if we're holding an option for a month, we want to make sure during that 1 month, we have relatively low amounts of decay. Now, I will say that there is diminishing returns because someone will say, well, why not just buy a 3-year option? The 3-year option will have the least time decay. And the problem with a 3-year option is that you're going to have less liquidity. So it's going to be more difficult to get in and out quickly because it's very important to time these. Hedging strategies are very sensitive to timing, so it's important that you're able to get in and out quickly. So when you buy a 3-4 month option, those are usually fairly liquid, especially in some of the broad-based indices and ETFs. But if you're going 2 years out, it may not be very liquid, especially in some of the ETFs that are that are not as active. So it's important that you try to pick an option in the 2 to 4 month range when you're buying a put option. And as far as strike prices go, this is really where you have a choice as far as how much protection that you want to buy. Just like an insurance policy, you can choose catastrophic insurance that will protect you only against a big event, and you're really just trying to prevent yourself from maybe going bankrupt in a particular case in an unlikely event. Or you can buy more comprehensive insurance that covers you in all different types of scenarios. It's going to be more expensive, but you have better coverage. So the question is, where do you want to buy protection during a correction? Now, I'm going to show you both because I want to show you the two side by side and show you how they perform one next to another to understand which one is best suited for you. So what I'm going to do at this point is I'm not going to say which one I prefer or which one I think is better or worse. I'm going to put the two side by side and help you guys make that decision for yourself. But to buy a catastrophic insurance, this is where we're buying an out of the money put, a put option that is usually about a 30 to 40 delta, not too far out of the money. And this will usually cost somewhere between 1 to 3% of the entire portfolio to buy this types of protection. And again, this will only protect your portfolio in a fairly major downside correction. Vice versa, an in-the-money option, and this is not too far in the money, about a 50 to 60 delta, will usually cost you 3 to 5% of your entire portfolio, but this will provide, like I said, much more comprehensive insurance or much more comprehensive coverage that will protect you in any downside correction. So in order to understand these strategies, what I'm going to do is I'm going to use OptionsPlay, and I'm going to compare these strategies side by side to show you how they perform so that you can draw your own conclusions as to where you think a market will go. So SPY currently closing at all-time highs at 324.87. Not typically when I would consider putting on a hedge, I will say. But if this market corrects a little bit, meaning if this market breaks below 320 or so, that's when I would realistically consider putting on a hedge or thinking about a hedge. But I just want to show you what this looks like. So what I'm going to do, and this is something you can do very quickly on your own, and I'll show you this with a different symbol in 1 second, is that you can always use the stock leg of OptionsPlay to mimic your portfolio. So let's say you have a portfolio that's broad-based, meaning it's a well-diversified portfolio. We're going to use SPY as the proxy for your portfolio. And it's important, again, to pick a ETF or stock or index that mimics your portfolio because that's how you're going to get an efficient hedge. And what I'm going to do is I'm going to modify the call option and the put option, the call option and the call spread to bind two put options. So I'm going to select a long put. I'm going to also select a long put here. And what I'm going to do is I'm going to select something a little further out, maybe out to March. And what I'm going to help you compare is that catastrophic insurance to that comprehensive insurance. So let's say I buy a 320 put, so an out of the money put option versus an in the money put option, maybe a 327 or 326 put option. So here is SPY at 320, let's just call it 325. I'm buying one option at 320, so about $5 out of the money. And I'm buying a put option 326, which is $1 or $2 in the money. Let's maybe go out to 327. So in order to truly understand how the strategy performs, before you actually compare the three strategies side by side, one way to give you numbers that actually are meaningful to you is to use our risk and investment calculator and put in the amount that you actually own in this particular portfolio. So think about your entire portfolio. Let's say you have a $100,000 portfolio. And What this does is it turns this stock leg into a $100,000 SPY investment, because this will be the proxy for your portfolio. And then what we're going to do is we're going to buy 3 put options against it, because you have 308 shares of SPY. So to hedge that, you would need 3 puts. And you can utilize this to help you calculate what is the appropriate number of contracts to purchase to hedge your portfolio. So it's really important that you pick a proxy that actually matches your portfolio, put in the dollar amount of your actual portfolio, so that you have numbers that are a bit more tangible and relatable to your actual portfolio. So once we do that, that's when we're going to use our P&L simulator. This is one of the most powerful parts of OptionsPlay, because it allows you to simulate all types of scenarios and see how these strategies perform. Now, I've gone out to March expiration. Now, in my opinion, if you do get a correction, it probably will happen a little quicker than going all the way out to March. So I would think that at the very, I would say maybe mid-February, maybe towards the end of February is a realistic time frame as to when I'm probably expecting a correction to be over by then. So what I'm going to do is I'm going to move this expiration date to a little bit prior to the March expiration date. And what I'm going to do is I'm going to first start off by presuming that the markets don't move at all, right? So pretend for 1 second that I'm completely wrong on this hedge. Markets don't move any lower at all. By February, the markets are exactly where it is today, meaning we just get some consolidation and it doesn't move meaningfully lower. So in my portfolio here, I'm flat, right? Because if the markets don't move anywhere, my portfolio is not going to lose any money. But if I buy this catastrophic insurance that cost me $1,800, which on a $100,000 portfolio represents 1.8% of my entire portfolio. So I've paid 1.8% to buy roughly 3 months of protection. This is actually relatively cheap, right? So many times when you hear about people saying protection is cheap right now, this is what they're referring to. Again, I don't recommend you go out and buy insurance today because it's cheap, because just because it's cheap does not mean that you should buy insurance, because it was cheap over here, it was cheap over here, it was also cheap over here, it was cheap over here, it was cheap over here, it was cheap over here. If you kept buying cheap insurance, you would have lost money. You don't want to do that. You're better off buying expensive insurance when you need it, because then you're only going to buy insurance when you need it. And I hope that makes sense to everyone. So compare that to the more comprehensive insurance, which costs $2,500, so about 2.5% of my entire portfolio. More expensive, but what I want to show you is that if the markets do not move any lower, the catastrophic insurance actually loses more money. So even though it's a cheaper insurance and you're thinking, well, if I don't need it, I'd rather have bought cheap insurance so that I'm not losing much money. But the problem with cheap insurance is that it's all out of the money and it's all time premium. You're going to have more of that erode if the markets do not move in the direction that you expected to. So here, not only do I not make any money on my catastrophic insurance, I've actually lost $1,000 on this. So I paid $1,800. I'm losing $1,000 on this because an out-of-the-money put option will erode if the markets don't move any lower. The in-the-money puts, as you can see, even though I paid $2,500, almost close to double what I paid for this, it will only lose $741. That's the benefit of buying an in-the-money put, because an in-the-money put will not erode as much. So even though I spent more, the comprehensive insurance is going to give me a better coverage, even if the markets don't move lower. So that is one benefit that you'll see of the comprehensive insurance. Now, let's say the markets do move marginally lower. Let's say it moves just back to this 315 level, which is where this was the recent high right before Thanksgiving. So let's say it moves up to moves down to 315. So here, my portfolio, this is about a 3% correction. My portfolio would have lost close to $3,000. I have a $100,000 portfolio. Markets move down 3%. I lose $3,000. On a catastrophic insurance, I make $422 back. So the catastrophic insurance starts to kick in and provides me some protection, even in a 3% correction, which in my opinion is a minor correction and not worth going out there to buy insurance. So it'll give me $400 back. So instead of losing $2,900, I lose about $2,500. Not much protection here, in my opinion, to pay $1,800. Now, in the comprehensive insurance, as you can see, I paid a little bit more, about $700 more. But as you can see, I'm immediately getting the gains out of this. The comprehensive insurance pays back $1,300 out of the $2,900 that I lose. Again, not dollar for dollar exposure, but provides me a fair amount of protection. So instead of being down $3,000, I'm down roughly $1,700. So the catastrophic insurance starts to kick in. Now, what if the markets move down to this swing low that we got right after that Black Friday or Cyber Monday here around 307? So as you can see here, if it moves down to 307, now I'm down 5% on my portfolio. I'm losing $5,300. Now the catastrophic insurance is starting to kick in. I'm making $2,200 back, so I'm losing about half, or I'm making about half of what I've lost back on that catastrophic insurance. Not quite half, only about 40% or so. The comprehensive insurance pays $3,400. So now my net loss here is only about $2,000 on a $5,300 loss. I'm gaining $3,400 back. So my net loss here is only about $1,900, $2,000. And as you can see here, now in my opinion, the level that I'm really targeting here is about 302.50. That's a major breakout level we had back here in October. This is a major resistance level we've been talking about for months and months prior to that breakout. So if we do get a major, some kind of sell-off, especially some of these fast, violent sell-offs that we've seen, I would target maybe around 302, 302.50 or so. And this is the type of scenario that I'm concerned about, is you get a pullback of about 7% here. I'm losing $6,700 in my portfolio. I only gained $3,500 back in the catastrophic insurance. Not a bad result in my opinion, but as you can see here on the comprehensive insurance, $4,700 back. So I'm, again, only losing about $2,000 no matter what with this catastrophic insurance. So the most I can lose really is about $2,000. The further it goes, I'm getting almost dollar for dollar exposure. So when I'm down $10,000, I'm getting $7,700 back. So again, about $2,300 loss total, as opposed to a $10,000 loss if the markets do move significantly lower. Now, I don't anticipate that happening, but that's always possible. You want to know exactly how much protection you're actually getting. So as you can see here, in my opinion, the comprehensive insurance gives you better coverage in all different market cases. So even if the markets don't move any lower, you actually still get better coverage. You actually just lose less money than if you bought the catastrophic insurance. The only downside to the comprehensive insurance is if the markets really take off. So if the markets take off and let's say move up to 340, here I've made $4,700 in my portfolio, but I've lost $1,700, basically all of the premium that I paid here. $1,700. Here, out of the $2,500, I lose $2,200. So I'm losing about $500 more or so on the comprehensive insurance because I'm paying about $800 more for it. But I would say that this is a worst case scenario. And in theory, if the markets do move any significantly higher, even in the next few weeks, right? So if I put on this hedge and by mid-January, the markets are marginally higher, meaning the correction that I'm expecting just simply has not materialized, then as you can see, these two results are actually almost identical. So at this point, I would argue that you should probably just take off the hedge and move on and no longer continue to try to hedge your portfolio. But again, this is why I say it's better to actually be late to hedging than early, because when you're early, you're going to find yourself many times, throughout this process, because if you're just thinking to yourself, oh, insurance is really cheap right now, maybe I should buy some, then you probably may have bought some insurance here, maybe bought some insurance here, maybe bought some insurance here, and you're buying insurance when you don't need it, and you're going to underperform because you're paying 1, 2, 3% every time you buy insurance. And if you pay that kind of money every single month, you're going to underperform. You don't want to do that. So it's better to be late than early. Not many other things that it's better to be late on, but hedging, in my opinion, is one of those things. Now, conversely, you can do this with any ETF. So if you have a technology-heavy portfolio and you want to use the Qs, you could do the same thing. Just remember, you want to make sure you pick an ETF or an index that closely matches your portfolio. You always want to use the stock leg of OptionsPlay to mimic your current portfolio. So here, 100 shares of Qs is $21,000. If you're going to set up a put option, you just want to make sure you select bearish, long put. Using our strategy constructor, you just click on modify for any of these two strategies, click on bearish, long put, and you can choose, like I said, an expiration date somewhere between 2 to 3 months out as a starting point. Here I'm going out to March because I do think February is a little too soon, and you can always compare an out of the money put to an in the money put. And make sure that before you actually do any comparison, that you actually use the risk and investment calculator to plug in your portfolio value. So if you have a $100,000 portfolio, plug that in. If you have a $60,000 portfolio, you plug that in. This way, whatever you're looking at is actually close to your actual portfolio, and you can actually have numbers that make sense, or contract sizes that make sense for your portfolio size. And then you can use our P&L simulator to simulate different outlooks, whether you think the markets are going to go significantly lower, a little bit lower, or even just to understand what your risks are if the markets do move higher. It's really important to know what are your best case and worst case scenarios so that you don't have any surprises after you put on your hedge. And as you can see here, I've been able to set up a hedge and analyze the Qs within just a minute, something you can't really do if you're just looking at an option chain. If you're looking at an option chain, you're looking at all these different options. It's difficult to say, well, if the market's correct 5%, how much protection am I actually getting from it? You can't do that from an option chain. That's why we created OptionsPlay, to help you set up any three strategies side by side. Extremely useful when you're trying to hedge. And for those of you that have very focused portfolios, let's say you have an energy portfolio that's really underperforming right now and you're trying to figure out how to adjust for it. This is one of the things that you can utilize OptionsPlay for. Notice how easy it is for me to click on modify, changing these strategies to short puts, setting up different put options to see how these strikes will be affected. Looks like XLE has had looks like there are some non-standard options here on XLE, but you can utilize these to set up your portfolio. So let's say you have a $50,000 XLE portfolio or an oil and gas portfolio, and you want to hedge further downside in XLE. This is a great way to go about doing so. And you want to you're concerned that oil is going to continue heading lower, or some of these companies are going to go bankrupt, as there are some cracks being shown right now in the energy markets. So you're concerned that your energy stocks, even though they pay a pretty hefty dividend, you rely on those dividends, but you want to hold on to that portfolio, but you're concerned about a correction. Use a hedge. Look at how a hedge might be able to protect you while allowing you to hang on to those dividends. So I hope that this was able to show you, number one, what a portfolio hedge is, what are your options as far as portfolio hedges, but more importantly, how can you become self-sufficient in being able to analyze a hedge for your portfolio with just the click of a few buttons using OptionsPlay. So with that, I want to thank everyone for taking the time out here this afternoon. I know this was a heavily requested topic, which is why I wanted to cover it the first thing out of the gate this year. I hope that you guys have found this useful. So with that, what I'm going to do is I'm going to open this up for Q&A. I'm going to spend as much time as I have possible answering any questions you guys might have. So if you have any questions, please type them into the chat window, and I will answer as many questions as I have time for here today. And in the meantime, what I'm going to do is I'm going to scroll up, and I'm going to take a look at the previous questions that were already submitted during the presentation. So some people saying you're not concerned about a pullback at all. Great, perfect. If you're not concerned about a pullback, this is meant to prepare you. This is not to say go out there and buy a hedge. This is meant to say when you expect it to. You know, Praveen is saying he doesn't expect a pullback until February 15th. Perfect. Then on February 15th, you now have the materials to know how you can go about looking at a hedge on February 15th. So again, this is not to say go run out and buy a hedge, but whenever you do feel that you need a hedge, this is how you go about doing it. Barb makes a really good comment. The Fed drove this rally and they are on hold. That's exactly how many people feel. And that's why some people do not feel that there is going to be a correction imminently. And you're absolutely right, Barb. So I suggest that, again, this is to help you prepare for when that correction does happen. Let's see. So Michael also makes a great point. Insurance is more expensive when your house is burning. You're absolutely right. However, because of how expensive insurance is, when you buy insurance when your house isn't burning, guess what? You're going to underperform your portfolio significantly. So your options aren't great, but your best option is to buy buy protection when the house is burning. It's going to be more expensive, but you're really going to need it at that time. Joseph is saying, how do we know when there's a crisis correction? Recent pullbacks of up to 5% were followed by gains to the mean within several days. What is the buy put timing? Great question. So this is really where you have to utilize the charts. And from my perspective, when I use the charts, and I'll pull up a chart real quick here to show you, what I'm looking for is a break of the last swing low. So what is the last swing low? The last swing low here for me was a fairly minor swing, but that's about the 320 level. So what I'm looking for is a break below that 320 level. And again, I wouldn't typically go out buying puts every time we break a swing low, because if I did that, I would have severely underperformed. But again, we are in a very, I would say, distinct time where the stock or the markets are significantly above its 200-day moving average. So this spread right here, the current spread between the 200-day moving average and the current price, is near an extreme level. It almost never exceeds 10%, and right now it's sitting around 9%. And whenever it typically gets to these types of extreme readings, you typically get a pullback. So, and these past readings have just been about 8% above the 200-day moving average. Right now, we're closer to 10. And that is, why I think that it's worthwhile paying attention to. If you get a break below that last swing low around 320, that it might be worthwhile taking a look at buying a put. Again, I want to reiterate, if you have the ability to move into cash, you should go do that. You should not buy a put option, because again, put options are expensive. But if you don't have that luxury of going into cash because you have capital gains to pay, if you do that, then you might want to take a look at a put. So I want to make sure that we qualify that. You have better options for hedging your portfolio, and if you have no other options, you want to make sure that you have all the tools to make this as efficient as possible. Jake is saying, remember you recommended a put spread on 12:30. There was no crash. Great question. Great point. But I think I want to make sure that I wanted to reiterate. We suggest initiating a hedge if you are concerned about a pullback in January. That's not to say that we were expecting a hedge in January. This was meant to say that if you were concerned about a hedge, here is one option that you can utilize. And I would specifically use a put spread because I wanted to limit the cost of buying that spread, because you might, because of how expensive buying puts were that particular Friday. So that was more of a precursor to this specific webinar to say, here's a potential hedge if you want to get ahead of the game, but we're going to talk about this particular hedge on this webinar today. So glad you're here, and I hope you learned something, Jake. Bradley is asking, does the profit include the trade costs? Yes, profit means your actual profit, not, it doesn't, meaning it's already accounting for your trade cost. Michael is saying, missed your opening remark regarding CNBC options action, please repeat. So again, just to reiterate, we are now on options action every single Friday at 5:30 p.m. I will be on that show every single Friday going forward. Nice way to ring 2020 in and show everyone the growth of OptionsPlay and how we're you know, contributing more and more to the options industry by contributing to things like CNBC. So hope to see some of you watching that show and responding to some of the tweets and interacting with us on that particular show. Wayne is asking, is the portfolio hedge a play to run when you are in fear that if there is a pullback that it will not eventually correct itself or turn the value of investment over an extended time? Wayne, yes. However, keep in mind that when you have that correction, depending on how severe that correction is, sometimes you end up pulling out of your investments during that correction. So this is a way to hedge yourself that during that time, if you do end up pulling yourself out, that you have some gains to offset those losses in your portfolio. If your investment horizon is extremely long-term and you have no problems sitting or tolerating a 5 to 7% correction, you should not go out and put on a hedge. So again, I want to be very clear. This is not for everyone. It's expensive. So you should do it only if you're fairly tactical and you want to try to prevent a loss in your portfolio in the short run, and you don't want to take a 5 to 7% downside on a short-term correction. Wayne is also asking, well, some XLs just went ex-dividend, resulting in non-standard trades. Yes, exactly. So that's exactly what we saw in XLE. Vijay, Shama, you're very welcome. Kaz, thank you so much. Scott, what about a vertical spread? So Scott's asking a really good question. What about putting on a vertical spread? You absolutely can put on a vertical spread, and especially when you expect a relatively shallow correction, a vertical spread is suitable in my opinion. So the vertical spread that we actually suggested was a 320, 300 vertical spread. And the reason I suggested that was because because I don't expect the markets to move significantly lower below 300. Why should I pay for all that downside? You can collect some premium and offset the cost of buying that put option. So if you're expecting a relatively shallow correction of the, let's say 5 to 7%, you're not concerned about a 20% correction like we saw in the end of 2018, absolutely, a put spread is a suitable strategy here. That was actually the strategy that we had suggested here on this particular trade a few days ago. What parameters do you use to determine whether a serious correction is taking place? Obviously, the timing is critical. So from my perspective, the parameters I'm looking for is really how extreme are the current are the current readings of the markets. And like I said, one of the parameters I'm looking at is how far away is the current market away from the 200-day moving average. Right now, it is near an extreme reading. That is the only time where I'm concerned about a correction. I wasn't as concerned about a correction up here because that reading wasn't quite extreme. So those are the things that I'm really concerned about when I'm looking at buying a hedge or putting on a hedge is the market at extreme levels? You know, are there risks of a pullback? And you also have to potentially sometimes overlay some fundamentals or just some geopolitical events that you see on the calendar. January 15th, the signing of the phase 1 trade deal, considering how much pain it's caused some of us throughout this year, how much pain it's actually, or how much slowdown it's actually caused the entire economy throughout 2019. I think it's a significant event, and it's an event that you might want to put on a hedge for. Again, not everyone agrees with me on that, so it's up to you as to determine whether you see that as a risk, whether you think the market is priced in. In my opinion, I think the market is priced in too much good news. I don't think it's priced in enough risk, and that's why I think this is a little different than most other quote-unquote extreme readings. What about SDSs to hedge? I'm not sure what an SDS is, Irving. If you could possibly clarify, I'm happy to answer that question. Andy's saying, why don't you hedge by buying VIX calls? So the question is, the correlation to VIX in your portfolio is very, very loose, right? So if the market moves down 10%, how much does the VIX go up by? The answer is you don't know. Vice versa, many times you might actually see markets move higher and VIX also move higher. So the VIX and the market's correlation is not particularly strong, and the VIX is only for 30-day SPX. So if your portfolio is not a broad-based portfolio, VIX might not be a very good hedge for your portfolio. That's why we don't use VIX. What should be considered as an expiry date? So Steve, exactly something we already discussed. So maybe if you watched the recording, but just quick summary, about 2 to 4 months out is usually a good starting point for an expiration date. Donald, would you explain the score in the red, yellow, green circles, and are they still accurate as you modify the puts? Yeah, so the OptionsPlay score is just telling you how expensive or how cheap the put options that you're buying. So in this particular case, both of these are relatively similar in terms of pricing. And your potential for gains and losses, as you can see, these two pictures look very, very similar. So your risk and reward ratios are very similar. Your probability of success here are relatively similar. That's why you have a similar OptionsPlay score. But if you move these strike prices, so let's say I buy a really far out of the money put option, as you can see here, I have very little potential to actually make any money on this far out of the money put, which is why it's got a low OptionsPlay score. So the OptionsPlay score is giving you a sense for both the risk reward and the probabilities in a single number, because that's something that's difficult to capture when you're looking at a page that looks like this. Because here it's telling you, yes, your max reward is $31,000 and you only have to risk $300 to do so, but you only have a 22% chance of ever making any money on this particular trade. So as cheap as it is, your probability is so low, it doesn't make a lot of sense to do this trade in the long run. That's why it has a low OptionsPlay score. Ray is asking, any thoughts on using non-leverage inverse ETFs? Can these be held for long periods of time? And the answer is no. So the non-leverage ones are a little better than the leverage ones, but still they will severely underperform in the long run. So the inverse ETFs will give you a inverse return over a single day holding period. But as you can see, if the markets move, let's say 5% lower over 5 days, your inverse ETF is not going to give you a 5% return. It's only going to give you maybe a 4.5% return. It will underperform every single day because it's effectively short the market and it has to pay the margin interest on that, and you're paying that margin interest through that non-leverage ETF or that short ETF. So if your holding periods are extremely short, meaning a few days, yes, the inverse ETFs, in my opinion, are suitable, but it does require a significant amount of cash to buy these non-leverage ETFs. So if you have a $100,000 portfolio and you want to hedge $100,000, then you have to buy $100,000 of this inverse ETF. That's not very cash efficient. Buying a put option will only cost you 2-3% of your portfolio. So that's why I recommend using puts versus the inverse ETFs. For small portfolios, do you recommend protection inside straddle or strangle? I would never recommend buying a straddle or strangle, because why would you pay for the call option if you think the markets are going to move lower? So Andy, I would not recommend it. I would simply recommend buying a put option. Jerry's saying, I have 300 delta in my portfolio. So Jerry, if you're referring to $300 in deltas, or could you, if you don't mind clarifying, what do you mean by 300 delta? If you just mean that you have a 3x leverage portfolio, then you might want to use the 3 times amount in order to determine how many puts you should have. Meaning if you have a $100,000 portfolio leveraged 3x, then you want to use a $300,000 portfolio and not just a $100,000 portfolio. If that's what you mean, I hope that answered your question. Andy's saying, does OptionsPlay platform show when to buy protection? So Andy, when you want to buy protection is up to you. We're not here to tell you when to buy protection. I am warning you that the current, where the markets currently stand, it is warranted of watching the markets to see if you do get a correction. So we're not here to tell you when to buy, but we are warning you that now is the time to consider taking a look at this. in the OptionsPlay platform, the 1 month and 6 month trend getting red means it's time to buy protection in uptrend. So Andy, I will say if the trends have turned red, it might be a little late to start buying insurance. So as you can see here, when the thing started turning red, yes, when the thing starts turning red, then that means we're in for a larger correction. So as you can see here, the markets turned red here in July when the markets broke below the 200-day moving average, but only spent 2 days doing that. So before it rallied back higher. However, what I will say is that when you get red trends and it resumes back into green, that's a strong buy indicator. So that's a good time to get out of your hedge. As far as when to enter a hedge, again, you want to be a little bit more tactical, a little bit faster on the trigger. So many times during these extreme readings, what I'm looking for is a break below the last swing low here, which is around 320 or so. So if we get a sell-off below 320, that would be my trigger. So a break below support level, in my opinion, is a better trigger for putting on a hedge. Praveen, thank you so much. Michael, thank you so much as well. Joseph, appreciate everything. Thank you so much. Victoria, also same thing. Thank you so much. Bob, thank you. Joseph is asking, if you break below the support line, do you consider that a significant correction? Again, just a break below a support line in general is not considered a significant correction, but given the current extreme readings that we are in, I do consider this a potential start of an extreme correction. Or I should clarify, when I say extreme correction, I don't mean an extreme, I mean a correction back to maybe around that 302 level, which is that major resistance level that we broke out above. Lance is asking, join late, will recording be available? Lance, all of our webinars are recorded, so you will always receive a recording after we finish here today. Bill, thank you so much. I appreciate it. Jason Seren, thank you so much. Mura, thank you so much. Molly, thank you so much. Looks like I'm at the end of the questions here. Again, I just want to thank everyone for taking the time out here this afternoon. I hope that everyone has a prosperous 2020. I hope everyone had a great holiday season. I'm really looking forward to the education that we have in store here in January. A lot of great topics coming up. Really looking forward to getting back into the swing of things. So I hope to see you guys here over the next couple of weeks. And I hope to see some of you participate on the CNBC show tomorrow. So I hope you guys have a great afternoon, and I'll see you guys next week.